Chapter 6, Forecasting for Financial Planning. And like I said, I record these for this class. They're not really for public consumption. So it came out handy where a number of people who missed other classes or just wanted to refresh on some concepts. I saw the big spike in studying for the exam. A lot of people watch these over. So it's not a bad thing to do. Um, So learning objectives, the importance of forecasting for business success. And this you could see directly in the Zoom simulation. When you're working on that simulation, if your forecasts are not good, then your results are not good. And by the way, next Monday is the next round of the simulation because we skipped this week due to the exam because I know that everyone was busy studying. All right. The financial forecasting process. So I'm going to walk you through that process. We're going to look at preparing pro forma financial statements. We'll do that on Monday. We'll actually bring a calculator and pencil, and we'll actually do the statements. And this is what you see when you're in the Zoom simulation and you go to the financial page and you see last year's financials and it says pro forma financials. The simulation automatically creates them for you, but I'm going to show you how to do it by hand so that way you understand how the simulation or how any company can create pro formas. It's basically an estimation of what the company is going to be doing next year based on the sales forecast. So it's sort of like if you need to estimate the taxes you need to pay next year, you would sit down and figure out what your earnings are going to be, and then you could estimate what your tax payments will be. So it's just sort of preparing. Okay. So the importance of analyzing forecasts, and this I'll tie back into the simulation a little bit to talk about um, how to best approach it in the simulation and how people approach it in the real world. Okay. So forecasting is extremely important for all businesses because this is what you use to really guide the company forward. Um, And as you know, if you forecast too much product and you don't sell it, what happens to your company in a simulation? You have a deficit or a financial uncertainty because you still have to pay for the materials, the labor, the storage. So you have a big problem if you over forecast. And you also have a problem if you under forecast, where if you under forecast, now you're giving up sales that you could have sold to competitors and things of this nature. So you want the Goldilocks forecast. Not too much, not too little, just about right. Yeah. So either one is too bad, and especially for an auto industry, if you overproduce a vehicle that's not going to sell, it doesn't get any more valuable next year. You lose. I don't think they reflect this in the simulation, but in the real world, trying to sell a last year's model, they're going to have to sell that at a deep discount, even a loss, just to get rid of it because, when a new year's model comes out, everybody wants that car. Who wants the last year's model, unless it's discounted? Yeah. And what happens in the apparel industry if, they order too many winter coats? What do they do? Honestly, what do they do? Yeah. Yeah. You're going to have to put it on clearance. So if anybody needs a winter coat, buy it now for next year, but it'll be last year's styles. If you need a bathing suit, you're going to be paying top dollar now because now all the spring and summer clothes are going to come in and the apparel, and hopefully, see, they have to order it so early because they have to put the designs in, have somebody make it, ship it back, and put it in the store. So that all happens now, like March is when they're changing over all the winter stuff to spring and summer. So they need to clear the racks of all the winter merchandise. Otherwise, they're going to have to really throw it out, or I guess they would never really throw it out, but they'll really deep discount it because by the time they get the spring and summer clothes in, if they made a mistake, if they misjudged what people are interested in buying, then they're going to have to offload those at a later date. And that was one of the reasons they initially had the idea of factory outlets, where they could kind of dump all the clothes that aren't selling at the stores into an outlet area, and then you could get deeper discounts, I guess. So okay. So let's talk about the general approaches, three general approaches to financial forecasting that managers should concentrate on. One is experience. This is why if you're if you graduate from our business program, right? So you could graduate in finance, in marketing, in management, and there's some others, I guess. I don't know what the other ones are, but if you graduate in finance or marketing, uh, generally there are significant amount of jobs available. Graduating with the management concentration makes it a little bit harder because most management jobs, they want experience before they hire you. Because, say for example, you're a Stony Brook graduate and I'm going to hire you to manage my restaurant or my business or my sales unit or my dealership. Why would I trust you? You have no experience. So this is one of the things that's really difficult. Unless you get in the management training program, there's the management jobs that are opened up, they always want people with experience because it's really critical to performing well. So experience in forecasting is very critical. I had a lot of jobs, not because I was fired from any of them, but because you know how life is, right? You go through a lot of jobs. Some people here, like I said, one class, you may have 15 jobs, 20 jobs before you retire. Some people here have already had 5 jobs and 6 boyfriends and 3 girlfriends. So you go through a lot as you grow, as you move. I remember I worked, one of the jobs I had that was, the professional jobs I had were kind of tedious, a lot of work and not fun to talk about. Hard for you to relate to, the type of technical jobs I had in finance, accounting, and computational finance. But I think everybody can understand how a movie theater works. And that I had a job for a long time managing a movie theater, then a chain of movie theaters. And I remember that forecasting was critical around, say, the summer or holiday season. And if you didn't order enough popcorn or candy or napkins or straws, you could easily run out. And when you run out, I remember we had Thanksgiving weekend. If you don't have your order coming on Wednesday, no one's going to deliver it to you on Thursday, Friday, Saturday, or Sunday. So you're stuck until Monday. So if you run out of concessionary items to sell, you're losing big money because that's where the theaters make all their money. Has anybody ever worked at a movie theater? It's not. You don't have to be ashamed. It's a completely legitimate job. Nobody? All right. Oh, you have. Okay. So somewhat I'm talking about. You want to make sure that another critical thing is now these movie theaters have all these different theaters inside. Have you ever gone to the movies and it's sold out? Right? So you went to go see the Lego movie and it's sold out and you got really disappointed because you had of course you had your younger sibling with you. You weren't there just for yourself, But that could be a problem of forecasting too because they have different size theaters and they have to basically forecast what movie is going to be the most heavily attended today. So if I was running a movie theater and it was raining out on a Sunday, I would put all the children films in the big theaters because generally that's what parents want to do on a rainy day, especially in the spring or summer, is bring the kids to the movies. If it was the week after Oscars, I would want the films that won a lot of Oscars to be in the bigger theaters because they're going to be more heavily attended, things of that nature. So if you mess up on the forecasting, you take a big movie, maybe the first day the Lego movie comes out, you're not convinced that that's not going to be a big movie, and you put it in a small theater, now you've just lost hundreds of tickets and hundreds of dollars at the concession stand. And although today, I think it's much easier to move movies between theaters because they're all digital on like a disc. And previously, in the dinosaur age, movies came, which is only really about 5-6 years ago, came on big film platters, like just big, huge rolls of film. That would be at least 100 pounds. Probability. Is anybody AMS minor, major? No? Okay, well, so, probability and statistics are also a big tool for forecasting. If so, what has happened previously, you can plot and project and figure out that it's going to happen, most likely happen again. So if you plot year over year, or that's why same source sales are important, and looking at, what happened on the Friday after Thanksgiving, the past 3 years. How many attendance did we have? How much sales did we have? What were the, you can get an idea of the days people like to go to the movies. And the biggest movie day of the year is the Saturday after Thanksgiving, if you can believe it. You know why it's a big movie day? Because people had their Thanksgiving, they had their Friday at home, they're bored, and now it's Saturday, they don't know what to do with themselves, and they go to the movies. And it's also they also release usually a good number of pictures that day too. So any weekend, generally any weekend where there's an extra holiday, like a Monday, like Memorial Day or not Labor Day, but Memorial Day, 4th of July, typically that weekend, you're going to have increased sales because after people do all their errands and do everything they need to do, that extra day they just don't know what to do with themselves, so they go to the movies. Right? Although I guess your generation, you would just go to the computer and find on one of those sites and watch it right online. Right? Do you do that sometimes? No. I hear there's sites where you can go and they stream the movies. You don't download them, you just watch them. But they're always horrible quality. And I can't do that because I feel bad for all the people who are employed at the movie theater and all the people who worked on the film. And so if it's a good film, I want to, contribute to the success of it by going to it actually. Download a car? No. Yeah. Well, because the idea of if you see a movie, are you really stealing from anybody? But because they think it's a victimless crime, I guess. But anyway, and then correlation is a statistical measure to look at how things how they track. Is there a lot of similarities in the tracking of the sales to particular days or times, and um, looking at a correlation principle. Okay, so let's talk a little bit more about experience. So of course this makes sense. If anybody here has ever run a business or worked in a business, you know that the more you work there, you develop a sense of what to expect in that business. And as business students, you probably all have full-time jobs right now? No? Anybody work full-time? Okay, well that's good because you need some time for school. But I'm sure in the past you've worked, and the businesses that you were in, you sort of after a while you sort of get the flow of. Say, has anybody here ever worked at a restaurant or place that serves food? Okay, so after a while you start to really get to understand when the people start coming in for the dinner, when's the busy period. For example, I guess dinner kind of starts at what 5:30 to 8 is busy, and then after 8 it starts to slow down. I went to that new Bahama Breeze restaurant last night. Have you seen this? Heard of it? Ever drive past it by the Smith Haven Mall? And I was hoping to go for happy hour because they have not for the drinks, for the half price appetizers. But the bar area was so small. It was like how much anybody supposed to fit in there? But the rest of the restaurant was just dead because after 10 o'clock, a lot of these restaurants just die off completely. As far as so, what did one restaurant do to keep the seats filled after 10 o'clock? Applebee's extended the happy hour from the bar to the whole restaurant, so you can get discounted drinks and half price appetizers. And if you've tried to go to this Stony Brook Applebee's on say a Friday or Saturday night after 10 o'clock, there's a huge wait because all those high schoolers, that's like their big thing to do, I guess. And then there's a lot of college people from Stony Brook. It worked. It turned Applebee's from a very sleepy restaurant to a very successful restaurant. All right. Okay, so let's look. I don't like that example, so we're not going to talk about it. But you get the main aspect that as you work somewhere, you have to start to understand the sales, the customer demand, maybe additional expenses. Okay, so let's talk probability for a minute. Past history tells us a lot about what's going to happen in the future. Uh, for example, past history could be your grade point average right now, how successful you were in other business classes will give me an idea of how successful you'll be in future business classes. So if you received an A in all your past business classes, most likely you're going to continue that trend. If you've been receiving B's in all your business classes, most likely you'll continue that trend. Unless there's something fundamentally different that happens in the decision of how you want to study or how much time you want to devote to school. Um, so managers can use this information to help estimate the future. That's why we use your GPA to figure out whether or not you can be accepted into a graduate program, because that your past performance is going to help us predict your future performance, and we really want to only admit people who are going to be successful. So here's another example of probability. There's this, I don't know if you've ever been to this convenience store called 7-Eleven. There's a few around. And in the 7-Eleven, the manager there found that 1% of the inventory of candy is lost to shoplifters. Um, so in the future, if she has a pretty accurate idea of what she's going to sell in candy, she has to add in this loss from shoplifters, right? Has anybody here ever stolen candy from 7-Eleven? No? I would imagine kids do that, right? That don't know any better or whatever, or their mom said, "No, you can't have that," and the kid just takes it. But I think 7-Eleven, I would imagine there's a lot of cameras in there. Every once in a while, I notice that a lot of people shoplift and get caught from supermarkets because they have usually somebody in the supermarket in the control room, like watching all the aisles and looking for people who look they're up to no good. And yeah, I usually see the video of one scam they do is someone's in a wheelchair and they'll grab the meat and they'll put it underneath their seat on the wheelchair or somewhere in the wheelchair, and then because one, people are just not going to want to approach them or accuse them because they're going to feel sorry they're in the wheel. They're not really need to be in the wheelchair. They're doing it to steal from the other big theft I see at supermarkets is these people who act dumb. They put cases of soda at the bottom of their cart or cases of beer, and they push the cart through and they put everything in the belt but except what's on the bottom. I see that a lot. Have you ever seen that? I usually signal the cashier. I'm like, I don't say anything, but I'm just usually, because whatever they steal, you wanted to add something to that? Okay, good. Have you worked in a? Yeah, mirror on the foot so you could see. It would learn. See, that's good use of technology because they know, just like I'm saying, that's a common way people steal from the supermarket is the stuff they stow at the bottom of the cart. Of course, it's an easy thing. It's an easy attempt to steal because you could just be like, "Oh, I forgot," and what are they going to do? I mean, you half the chances are you probably did forget. So it's not like you took something and hid it in your jacket. Now you're dead to rights shoplifting. So, but there's a number of cashiers who aren't so diligent. Like they may not remember to look at that mirror, especially if they don't have the pop-up. Now, why I usually signal the cashier that something's going on is because whatever they steal means they have to increase the prices and you pay more for everything else. So every time someone steals from a supermarket, they encapsulate that in the prices they charge everybody else. So that's why, you know, I'm not too keen on people doing that. And it's the same thing for clothes. People steal a lot of clothes. So the price you pay for your clothes probably includes $1 or so for the fact that people are going to shoplift other clothes. You know, what's that? Well, there's a lot of fraud in car insurance, which is a different type of theft. But yeah, you're probably paying $100 to $200 a year in your car insurance in New York to count for that fact. But managers who are running a store are going to need to know this, and they're going to have to plan. They can't forecast exactly because they know a certain amount. And you know where most of the theft in stores come from? It's not the customers; it's the employees who do most of the theft in stores. You know, and we've all had jobs, especially if you had jobs involving product or food, and you've taken something, right? How many cashiers at the supermarket just grabbed a soda from the cooler and forgot to pay for it? No, nobody? Yeah. Well, they have cameras on you, so they can watch you to see if you like. So say somebody comes, your friend from school comes to the supermarket, and you try to just like push the item through and not scan it. They have cameras on you, so they can kind of right. So they can kind of see any type of activity that you're doing because it's that's big of a problem. They'll invest millions of dollars to try to have surveillance, undercover cops in not cops, undercover security agents in stores. Ever see someone in the store that doesn't quite fit in? You know, like a man in the ladies' department, just walking around looking. That might just be me, but they do have these security officers that go around and try to spot shoplifting. Yeah, that's the sometimes it's more obvious than not because they're not really shopping and they're there way longer than they need to be. But they're there to make sure that, although there's pretty good security in Apple, most things are like tied down, but I guess you could cut those wires or rip it off. And so there is always an element. Most stores, department stores, have an undercover person to look for shoplifting. All right. So correlation is a statistical measure looking at the movements of two variables. So the way we would look at this is that if both variables move in the same direction, they have a positive correlation. So if, say, a mother and child at the mall, they'd probably be positively correlated. Wherever the mother goes, the child goes. But say it was you and your brother at the mall, that might, or your sister, you may have a negative correlation that you're going to go to different stores and you're not going to be hanging out or walking together. And maybe you get the mall, you arrive together, do separate things, and leave together at the same time. So I think a classic example is that if interest rates go up, a real estate agent knows that sales of houses will go down. So the higher the mortgage rates, the less houses will be sold. So that is sort of, we could use. Another classic example is if it starts to rain, you'll sell more umbrellas. So if you go to, say, Manhattan and it rains, you'll see a lot more people selling umbrellas on the sidewalk. If it snows, you're going to see a lot of snow shovels and snow brushes being sold. And you may even, I went to the first snow of the season. I think I went to Aid Auto Store to get like an ice scraper or a brush. And they were like, we sold out. So I said to the guy, well, that's poor forecasting. What do you know about it? I'm like, well, it pretty much is going to snow every year, get cold every year, and why not before that happens, you stock up on a lot of these, so that way when the day comes where people want to buy them, you can actually. So he said, well, we're not the only ones sold out, and this is sold out, and that's sold out, and so then I went over to buy something at Pathmark because it's close to my house, and they had a big box out front with brushes and scrapers, and that was someone who knew it snows. We forecasted that we're going to probably sell X amount of these. Let's bring the box out and charge a huge markup and sell a lot of shovels and brushes. And so that's an example of how they captured sales because all these places that should be selling the stuff sold out. Okay, so the sales forecasting process, if we look at marketing, management, production, accounting, they all really have to work through finance because finance is the person that controls the money. So if you want to do anything, you have to really get the money from finance. So if marketing is going to come up with a sales estimate, so if you're doing your sales forecast, and sales and marketing, they're usually the ones that come up with how much you're going to sell based on what you're advertising, what you're building, and the likelihood that people are interested. So you have to let the finance department know so they can crunch the numbers and they could say, and this is what you need to do in the simulation. You can say, I'm going to sell 5,000 sedans at this profit margin. And that profit margin equals $30 million worth of profits. So when the marketing department comes in and they schedule $40 million worth of advertising, it's finance who stops and says, listen, you're spending $10 million more than we could possibly make on what you're forecasting. So you need to trim down your marketing budget, and we'll give you between 5 and 10 million, so we could have 20 million in profits. So that balance has to be struck because marketing people just want to keep spending money because they are driven by sales numbers, not profits. They want to generate the most amount of sales possible. So one way to do that is to spend money on advertising. because they're not really tied to profits, they're tied to sales. But the finance people are tied to profits, and they have to maximize the wealth of the company. So they need to go back to marketing and basically communicate with them. And sometimes it may be the case that marketing is estimating the sales that are beyond production's ability to make them. So finance is usually, would let production know, how much they're going to be building, and the production would have to get back to finance and say, listen, this is great, but we're going to need a new factory, and you're going to have to give us $10 million to build a new factory to be able to make enough cars to meet your forecast. So then finance would have to release money for production of for additional capacity by buying new factories. Now, top management is really who are setting the management of the company, sort of like your team in a simulation, your top management. You need to work together on your policy and your strategy. Are we making high-end cars at a high price with a high profit margin, or are we doing economies of scale? We're trying to make a car that's cheaper with a lower sales price to sell more of them. So the top management has to also communicate the strategy of what the company's trying to do, so finance can kind of coordinate it. And then finally, accounting is going to prepare all the pro forma financial statements and prepare all of the taxes and all the paperwork basically to give to finance, so financial analysts can analyze and say, okay, if we're forecasting, if top management wants to, increase profit margins and increase sales, if that's sort of the policy and the strategy through high quality, then the marketing needs to be hopefully increasing the design of the product, and that's also sometimes they work through engineering or product development. In order to increase profits, you either have to raise prices or lower costs, or both. So all this needs to have to be communicated, and it's a teamwork, and it has to all function together. So no one department can really run completely by itself. And finance is sort of the traffic cop with the flow of the money to make sure that everything makes sense what everyone's doing. Because you don't want production buying 10 plants for capacity that's not needed because the sales forecasts are slow or sales are slowing. I mean, you want everybody to kind of communicate. And that's one reason that the forecasting process can be really difficult, because there's a lot of inputs that go on through various people. Okay, so the sales forecast is really key to running this whole operation. So if the finance department, in cooperation with other leaders of the company, if they come to settle on a realistic sales forecast, then they could set the budgets for how much we can market and still make a profit. And they could set the production schedules as far as expanding capacity, putting on additional shifts to meet the production requirements for the sales, and then basically have accounting verify and write up all the pro forma financial statements and such, so we could get just a really good idea of what our estimated profits are. And these estimated profits go out to investors. And that gives them an idea of whether or not to buy or sell the stock. And what we're all trying to do here is maximize the wealth, so we want to make it more of the stock more appealing. So say we're going to plot the past sales, and these are 2002 to 2010, and we're making plots. Every dot is a sales level, and we can see a nice trend line. And you have this in the simulation that all of your auto different segments are increasing in sales year after year. So you're going to have a nice upward slope. Now, you can extend that growth into. So if you have sort of an average growth rate, you can use that to apply to next year's growth. So if you look on that, that's why that one chart is really critical, where it says actual versus market potential versus actual. You don't want to grow your actual sales. You want to grow on your market potential. So maybe you forecasted 1,000 cars, but you could have sold 1,800 cars. So when you look at that 1,800 cars, imply a 25% increase to that 1,800, and that's most likely what you'll sell next round, not based on what you actually sold, because you may have produced too little the previous round. Now, what if a new product is introduced? You can't really do this with the simulation, but companies do this all the time. So say you're going to have a new product, then you have to figure out that what additional sales you're going to get from that new product. So say in the simulation you're able to make a hybrid car. and that's going to, now you have a fifth category, and you can boost your sales based on selling that car. But what you have to be careful of is, are there people who are not going to buy your economy car and instead going to buy your hybrid car? So that's not really a big sales gain. So you want to attract, you always want to put up products that will attract new customers. The in some cases, companies may do a product extension where they come up with a new type of Oreo. But if you go in the supermarket today, you'll see, a whole section with maybe 30 different types of Oreo cookies. Generally, most people are going to buy one package of Oreo cookies, so they're hoping that the new redesign will attract new customers, not just get you to switch from, double stuffed to fudge covered, because that's not really boosting their sales too much. Okay. So if you are going to increase your sales, and this from the simulation, your current assets, inventory, accounts receivable, and cash are all going to acquire additional resources. So accounts receivable is generally thought of as a percentage of what your sales are going to be. So we can estimate the accounts receivable based on a percentage of your sales, and the inventory is going to be based on the more you sell, the more inventory you're going to need to provide the sales for it. So forecasting additional amounts is going to require more current assets. Just like if you were, say you were a fast food restaurant and you decided to, for some reason your sales were going to double that day. You're going to need more food, you're going to need more of everything to satisfy those sales. In some cases, you may need more plant and equipment. If you're building new factories or new locations, a sales increase, you may have to expand and get multiple locations or additional factories, depending on what your business is. Now, the pro forma financial statement, this is a horrible slide because it's just all words. So the pro forma financial statement is going to map out, based on your sales forecast, what your company's sales, profit margins, operating profit margins, taxes, everything, all the variable costs are going to be calculated to give you basically an idea of what profits you're going to make. And what we could do with the pro forma financial statement is that we can make relationships. So if there's a relationship, a percentage of accounts receivable to sales, and we'll say that every time we have $1 million of sales, 20% of that winds up being in accounts receivable. So if its sales go from 1 million to 2 million, our accounts receivable is going from 200,000 to 400,000. So we can make a relationship between different items. So sales is the key. So we can make a relationship that if sales increase from 5 to 8 million, and production capacity is full, the dividend payout will be 70%. There are what we call spontaneous balance sheet accounts that's going to increase in the same proportion or consistent proportion to sales. So there's some items on the balance sheet that will adjust spontaneously to increases in sales, and we could figure out what those percentages are, and then we can forecast them on the pro forma financial statement. So for example, step one would be determining what is the actual sales growth. So new minus old divided by old is how you get a year-over-year change. We know that from the overview page and of the simulation. And here they have a 60% growth in sales. So they're going from 5,000 to 8,000 in their projected sales. So cost of goods sold is directly related to sales. For every item you sell, there's going to be an increase in cost of goods sold. So since we have a direct relationship, we can, and sales are going to increase by 60%, then we can increase cost of goods sold. We can estimate that's going to increase by 60% as well. And it's so the idea is sales are going to go up, and the same 60% increase in sales is going to result in a 60% increase in cost of goods sold. Now, the actual amount will differ, but this is a pretty good estimate. Now, we could also get the percentage increase of sales, which we figured out was 60%, and we could just multiply. If the current assets are going to increase to the same percentage of sales, we just multiply 1 plus the 60% to increase our projected current assets. And that's cash, accounts receivable, inventory. So now our net fixed assets, if we figure out that our fixed assets have a relationship to sales, we can also increase those by 60%. But every company is different, so there has to be a set of instructions telling you, and this is any pro forma financial statement you'll do. There's a unique set of instructions for every company. And so for some companies, they say fixed assets have no connection to sales, and that might be like a software company where they don't need a big production facility and they could really easily meet any demands of sales. Step 4, forecast the increase in spontaneous liabilities. So not only do assets spontaneously increase with sales, so do liabilities. So if we're going to increase our sales, that means we're increasing our inventories, which we're most likely going to have to increase our accounts payable as we order components to, what is that noise? Is that someone's cell phone? Oh, upstairs. All right. So we have 60% increase in accounts payable will result in because the 60% is the increase in sales. So accounts payable will likely be a spontaneous liability because you increase the size and scope of your business, your payables are going to increase. Okay. And the same thing with your accrued expenses, most likely increase as well. And again, we're just applying that 60% increase in sales to these spontaneous accounts. Now, the retained earnings is a slightly different account. This is basically the money the company makes that they keep. So it's only if a company has a net profits, there's two things they can do. They could pay it out to investors in the form of dividends, or they could retain it for the company to use. And retained earnings accumulates. So they have a formula here that we're going to go into the exact formula on pen and paper next week. But the idea is that you have a number in retained earnings. Whatever additions to retained earnings you calculate from the income statement, that gets added to the balance sheet in the equity section of retained earnings. So retained earnings for companies grow. So if we had $2 million in retained earnings last year, and the company looks to make $3 million additional retained earnings, now the retained earnings account is going to have $5 million in it because it keeps accumulating. And the same thing with the depreciation account will do the same. All right. Other accounts will be held constant. So no additional funds will be needed. So there are certain accounts where, say for example, long-term debt. If the company's not going to borrow any additional money, that may be held consistent or constant. And that again would be the set of instructions when you do a pro forma financial statement. As a financial person or accountant, you'll get a set of instructions. These accounts remain the same. These accounts will be affected by this percentage amount of the sales increase. Now, additional funds needed is going to be sort of the end result of a little bit. All right. So if we look at, say, total assets are 8.8 million. That's the problem. There you go. And total claims are 6.6 million. Your balance sheet's not balancing, and that's a problem. So the 8.8 in your total fixed assets versus your assets and liability means that there's additional funds needed at 2.2 million. So if you're buying and needing additional assets, and you only have 6.6 million in liabilities and equity, you're going to need to borrow more money. So additional funds, and does this look familiar to you? You see this on the simulation. So you get the bottom of the simulation on the pro forma, and you see surplus or deficit. That means if you have a deficit, what do? You go back up, additional funds for long-term, short-term issue stock, so you can get it to a surplus position. And that's basically one of the big things of the pro forma financial statement is it lets you know ahead of time what your financing is going to be. It could be something similar in your life. Maybe at the start of the year before you start school, you're going to need to understand how much school is going to cost, and what your sources of funding is. So if you know if the school says there's going to be a tuition increase and you're going to have to pay us $20,000 next year, then you're going to have to look up, okay, what's my Pell Grant, my TAP, my student loans I could get, and then you add all that up and say, okay, I still need $3,000. So now you have to work this summer to make $3,000, or ask your parents, or some other method. What'd you say? So here again, 2.2 million needs to be raised. You could do it through notes payable, short-term debt, or long-term debt, or issue new stock, just like the additional funds column on the simulation. And that's why we do the pro forma, so we could really get an idea: are we going to be profitable? Are we going to meet the goals of our owners? And if we're going to need to borrow more money, we have a head start, because you can't just borrow money instantly. You generally have to plan for that. So, in summary, we want to determine the sales growth. And that you could, luckily for the simulation, they give you the percentage sales growths. So you want to use the sales growth to project your next year's sales of your autos. Calculate the projected net income. Project the assets you'll need to support the sales. So that way you have a head start on building your factories, expanding your inventories, planning for enough additional cash to meet your forecast. And then use the historical relationships between balance sheet and income statement accounts to increase your spontaneous assets and liabilities. And then we project our additions to retained earnings off of that. And determining the difference between the assets and the liabilities will give us an idea of how much we have to borrow. Because if outside financing is required, it's not like the simulation where you can just put a number in the box and get your outside financing. You're going to have to actually work on this ahead of time to secure, just like if you're going to buy a house. You can't just get the mortgage for a house in 1 week. It can sometimes take 2 weeks, 3 months. 2 months, never 2 weeks, 2 months or 3 months to get that. So these projections help for the planning of additional financing for the company. All right, so that is Chapter 6. One last thing I want to say is that if in your sales forecast, it's a little bit more, in the real world, it's a little bit more detailed than, say, in the simulation, because you have to worry about competitors, new types of products, and specifically substitute products. So if you have a sales area, say automobiles, you have to worry about a substitute product. Like, what if they extended the subway system all the way into Nassau County? So all the subways would be extended through Brooklyn, Queens, and directly all the way up to the borderline with Suffolk County. And they made a pretty elaborate subway network inside of Nassau County. Would that reduce the amount of new cars we're going to sell? For some people, yes. They may say, I only use the car to drive back and forth to Manhattan. Now I can easily use the subway. Just like a lot of people in Manhattan don't have cars because the public transportation is better. If they made a personal teleportation device that you could teleport from a pad in your house directly to work, or anybody else, anywhere else. This seems really far-fetched, but I've seen shows where they're actually doing research on this, and they've actually teleported particles between locations. So something that could happen in the future. You may look at me like, oh, you're crazy, teleporters. But 100 years ago, people would be looking at me if I said, oh, one day we're going to travel to the moon. They actually said it's impossible to travel to the moon because you can't escape Earth's orbit. And then one day they invented and discovered rocket fuel that had enough propellant to get us out of the orbit. So in the real world, it's a lot more complicated because of substitute products, or just a killer product, a product that comes out that just really so great, it really decimates your product line. So say your Hoover vacuum cleaners, and they come out with a Dyson. That's a vastly improved vacuum cleaner. It really took a toll on a lot of vacuum companies until they could make their knockoff products. And even say in the phone industry, when the iPhone came out, that took a lot of sales away from. Can you give me an example of a company that really got decimated by the iPhone? BlackBerry. So that was something BlackBerry didn't see the iPhone coming and all the functionality it had, and it quickly devoured its smartphone market. So in that case, their forecasts will all be wrong. They just didn't anticipate what Apple was going to do. So there's a lot of other uncertainties built into the financial forecasting that you have to watch out for.